All right. Good morning, everybody. We have CPI this week on Wednesday, which gives us the opportunity for a liquidity gap play. I really like that play. Um, we kind of have the opportunity on PPI too, but the history just isn't there. The getting the gap closed or even getting a gap just isn't as common on PPI, but it is there. So, there is the opportunity for it. It's one of the biggest things we have on the table, other than all of these Fed speakers. I didn't see it listed anywhere, but Yellen is going to be on Bloomberg today, 10 o'clock. I doubt she's going to say anything, earth shattering, but there's always the chance that she can put her foot in her mouth and say something that gets taken out of context, or just be misunderstood by a reporter, and the algos will trade what it's been told to trade. So definitely want to just watch the clock, and it's at 10 anyways. We'll be watching the clock at 10. If she says anything relevant, it will show up in finance juice. So even though they don't have her listed here, once she starts chipping teeth, if she says anything noteworthy, they'll put it in. Japan is basically flat. Same with the UK, Hong Kong, the Dow, S&P. When we get to the NASDAQ, we're actually out 0.25%, and then the Russell on top of that. So small caps today. We'll expect to see things like solar maybe up in the pre-market, pot stocks. Just kind of think about all the different directions that GameStop is up this morning in the pre-market. So we could see, a little bit of a short squeeze today. If you look at the market on close imbalance on Friday, you'd see also, that there was more on the buy side. We could start to see a little bit of a rotation. It's possible. I did post the founder's notes from Friday and for this morning. It's really nice when they get them out early in the morning. I haven't had a chance to go through everything yet. Unfortunately, I'm still having Bluetooth issues. So it put me behind. I haven't had a chance to read the spot gamma notes, but you're going to want to read those notes. Those notes help explain what's going on with the put wall, the call wall, volatility trigger, and those are the things that I get asked a lot. What are these levels? What do they mean? What does it imply when they roll them up or roll them down or don't roll them at all? And what are we going to do if it hit one? The notes generally do a good job of explaining in past tense what happened when we did hit one of those levels, and then kind of lays out some plans if they think we're going to hit one of those levels on the day or on the week. We have a lot of Fed speakers, but the message really isn't changing, right? And that's something to pay particular attention to, is what are they collectively trying to say? Because they all want to come out and, try to imply that they are their own person with their own thoughts and agenda, but really they're all just the same, right? It's just a mouthpiece. They're all singing from the same book. They all are supposed to be supporting the same message. It's not higher for longer. It's we're staying here for longer, right? The idea that we're not going to raise rates more, they're just not going to cut unless their arm is twisted, and they have to. And that tiny little data blimp from last week with the slight increase in unemployment, that's not going to do it. So we'll get a data out of Japan tonight. It's something to be mindful of. We got CPI, so we expect Monday and Tuesday and part of Wednesday to be this sideways hurry up and wait on CPI holding the range. But with this data coming out of Japan tonight, we could absolutely break out and hit the edge of the weekly expected move by tomorrow morning. So something to really be aware of. So PPI tomorrow, PAL tomorrow, CPI on Wednesday. You can understand why the market very likely is going to do that sideways dance. Until proven otherwise, we'll want to buy into weakness, sell into strength, play the range. And we have the front end auction. Those aren't really the big ones, but I would never say to ignore data. There's a thing called the 5-bar rule. It's just a off the cuff kind of phrase that when the market moves up or down 5 days in a row, then you expect a little bit of a pause. Apple's notorious for going 10 days, 12 days. I heard on Bloomberg this morning they were talking about Dow and these multiple days in a row. So it's worth noting, not only did we run, and sure, it shows some down days, but that red bar is still higher than the previous bar. So don't let the color of that candle fool you. It was still an up day. Same with this one, it was still an up day. And if you wanted to, depending on what platform you use, you can use, instead of candles, you can use candle trend. What that'll do is if the candle was a gap up, but it still closed higher than the previous day's candle, then it'll keep that candle color the way it's supposed to be, green. It'll just be hollow or solid in this case, hollow for red ones and solid ones for green ones. And it's just a way to tell if you don't like to use those bars. To me, I really like a bar chart, except that these things are so skinny. If you're not zoomed in on them to where you can see them, to me, they're just hard to see. So, these things do a great job of telling you the open and the close. And if a broker would give me a chance to fatten those lines up, then I would probably just use bar charts all the time. But the trend chart, trend candles, they can help you with that if you're struggling. But Dow did come up into this gap close. I know it might not look like a gap, but it's like a leg out or a liquidity gap. We got there, overshot it, but dojied. So we'll see if we keep going. There is this level up here, 397.82. This was a real gap instead of just a liquidity gap, and that got closed last week. We could see a pause in the Dow. Think about the names that are in the Dow, and it kind of takes us back to the Bank 7, basically. They are hedging in the Dow this morning. We got a really light volume coming in at 46. That's the lightest we've seen in quite a long time. Really, I would have to scroll back to even try to find it. It's been that long. A few weeks at least. We are really far away from the put wall. We're going to be watching that today and see if they roll it up. But if they weren't willing to move that call wall, then it's likely that they're not going to move this put wall. And I say that, but remember last week we were hitting that call wall, right? It was at like 52.20 something. 52.24. We hit it here, and then we came through and we hit it again, and then we were above it. So they rolled it from 52.25 to 53.25, just kind of rounding here. It's not to the penny. So they put 100 points here. I would take that as a bullish bias. But I want that put wall moved up with it to confirm that bullish bias. Otherwise, it just seems like they had some expiring options and they weren't going to put them on, roll them at their current location. So they rolled them up. It just takes some of the bullishness out of it, right? With that call wall, since we were already above the call wall when it got rolled, we weren't moving into it and then they rolled it. We had already breached it. We were above it. We were going to close on the week above it and it got rolled. I feel that's less bullish. Maybe it's semantics, right? Maybe. We are closer to the upper ADR than we are the lower ADR. $52.71. So if we do get the inside day breakout above 52.64, we're very likely just going to stall out against that 52.71. And that would make sense, right? If we're going to hold the line for the week, then we're going to expect something like a 1.236 or a 1.11. That'll be our flip point, and we'll come back down to develop deeper into a megaphone pattern. Look at how that lined up. There's the 1.236. It's right on that ADR line. We're closer to the upper one than we are the lower one, which gives us that upward bias automatically. We opened underneath the pivot channel, but we've already crossed through it. So we could consider, an R1 level for like 1 up, 2 down. And we are above the weekly pivot starting out. This channel is a little narrow. It's not narrow enough, right? If you've heard me talk about these channels, the more narrow it is, the more it implies a trend day or a breakout and run day. It's narrower than Friday, but it's still not as narrow as we would want it to be. So it's opened above the previous one completely. It's not overlapping. The channels aren't touching. We didn't open above it, but when you go through any of that material that talks about how price opens around the pivot point, it's talking about the RTH open, not the Globex open. So think about what that's going to look like when we get into the RTH. If we're going to be opening above this pivot point, this entire channel, and it's a gapped up channel, just like Friday was a gapped up channel, it's very likely that this channel is going to become a magnet. The question at that point is, are we going to hit the ADR line first and then fade back to the pivot point? Or are we going to hit the pivot point first and then go up to the ADR? I got to say, if we hit pivot first, I'll be looking to go to the second ADR. If we hit the ADR first, then I'll be looking to go down past this pivot point. And it opens up the door for us to touch that weekly. That'd be more bearish than I would expect, though. So you know, if we do get through this pivot, we'll focus on our own Globex low. If we get through that, then we've got the RTH low. That gives us some levels to focus on. Level by level, just working our way down. Friday's low is a cog line, 52.32. So we can add that to the bias as well. And this is an untouched pivot point. It's a MDP, missed daily pivot. I'm still of two minds on these missed pivot points, but if you were to carry it forward, it would only be good for one day, right? So it's an untouched pivot. It's good for one trading day, so you could carry it forward. And then we have the weekly pivot, and then this another cog line at the lower ADR. 52.11 is the cog. That's close enough. It's 52.09. So plenty of levels, level by level, all the way down. I want a half back as another piece of that. We can see it's the upper channel line, so we don't need to keep our half back line drawn on there. We can just see it. It's the upper channel. But that is a half back. So that also is just another piece that we would hit on the way down. If we didn't have enough pivots, we could mark out the Globex from Friday and hit that half back. We can see price did respond at that level. It still has interest. And then for the breakout itself, remember double tops and double bottoms, they're bear traps and bull traps. So if we do come back up and challenge Friday's high, that's a double top. Double tops are a bull trap. It's only going to be a trap if it looks convincing, right? So if it price comes around and comes back up and it hits that level perfectly, stops right at Friday's high, that's not a trap. What person is going to get bullish there, right? If we're trying to trap bulls, we need to convince them that we're actually breaking out and that they need to go long so that we can do a rug pull and trick them and trap them. If we run right up and just tag that line, that's not what we're looking for, because that's not a convincing trap. We need to go through that line and get into like a 111 or a 1236 fib line. We got to get enough above Friday's high that the bulls actually step in there and think we're going to break out and run, so that then we can trap them, trick them, squeeze them, drop them on their head and all that good stuff. So if it hits the line perfect, I would be very cautious of trying to short that, because what we've seen a lot of times, if it's a perfect tag, it instead pulls back and forms a cup and handle, which is bullish, right? So you see the distinction between the two. If it comes back up and matches perfect, we look for the handle, should be about 1/3 on the pullback, and then we'll look for the continuation. But if it comes all the way around and it overshoots, then that's our double top. That's a bear trap. That's a bull trap, and down we go. Now that's not perfect, right? You know, sometimes it doesn't work out that way, but go back and look, that's the way it's supposed to play. We even got a little one here from last week, right? Same thing. It's just a smaller version of it. That was our high, pulled back, building like a cup or a double top. We overshot that level just enough to get the bulls convinced that maybe we were going to break out and continue up, and then down it went. As a part of this discussion too will be reciprocation of VWAP like zipper. So we're not overstretched yet. In fact, right now, it just seems we're getting what we had back here. But if we do continue to outrun that VWAP really fast to get to the ADR levels, then measure that same distance to the downside. We don't really want that, right? It would be better if we slow down a little bit, let that VWAP catch up with us. And that way we don't get too extended, kind of like we did back here. We just slowed down, right? Let the VWAP do its thing. So we have our Globex low. We have the RTH low of yesterday. We have the 3-week moving average underneath this as well. Then the volatility trigger. And then the 10-day moving average. And scattered throughout all of this are a bunch of these voodoo lines. This little, I know it's extremely hard to see with the chart color that I have, but there's a line here. There's another one there. Those are voodoo lines. These red ones are a part of spot gamma. Ten-day, 30-minute volume profile, like we discussed on Friday, it was very likely going to move from that location up to this location, and that's what we have. We didn't revisit that area on Friday, but we didn't need to. We had already built out all that volume so that as these candles here start to fade away, this volume is going to fade away. And that means that this volume will be the largest volume on the chart. Now think about that from what we have right now on this 10-day profile is that this week right here, that's Monday through Thursday of last week, built out enough volume to take over the other 6 days that are on this profile. So we ran up, got into a lot of volume as a part of a topping pattern. It's got to make anybody a little bit nervous, especially if we had broke below it, because then we would have had all that volume overhead and we would have had to challenge it again later. Instead, we built out all that volume and we're above it. So that's going to help if we do make moves to the downside. I'm not going to say necessarily that it's support, but it is potential support. We don't have a classic shape this morning, like a D or a B. So right now it's just an air pocket below that. If we were to break, call it 5,200, then we could easily drop another 50 points down into this old price shelf, that 51.42 area. Friday offered a VPOC, but we've already ran through it multiple times, so now it has no value. If you don't have enough pivot points and you want some more, go through the textbooks on learning a volume profile, and they'll tell you about the value area high, the value area low, and the point of control. And they'll tell you about how you can push those forward into today's trading range. Now, I don't do that. I've already got enough pivots. I don't need it. It doesn't mean that they're worthless, just that I have enough. I don't need any more. I bring them up though, because look at where the point of control is so far for today. It is at the value area high. So if you were trading in the overnight hours and, say you live overseas, you're not living in the US, so you're up at 2 in the morning, whatever, that would have been an area of concern on these moves that we were getting to the upside. It was the value area high at the time. It wasn't yet a point of control because all this volume wasn't there yet. So it would have made sense to have that on your radar. It would have been a nice heads up that we were coming into some significant resistance. That's where we stalled out. So 52.50 this morning now is going to be an area of interest if we do fade back. Now we're not getting anything on the numbers here that really stand out. Yeah, they are. They're hard to read, but I keep them that way. Keep them hard to read. That way they're only there if I really need to see them. We had some pretty good numbers right around this 52, 56 area. But really it's 52.50 that we want to be concerned with. So if we get back to VWAP, basically, right? We come back over here, look at where VWAP is, 52.52. I mean, it's really close to VWAP. Or to that round number. Now remember, your bias on a sideways day is more valuable than the candles, right? If you've heard me go through this, candles will sometimes lie to you, and you have to play the bias, especially on the edges. That's why the bull traps and the bear traps work. The candles will tell you, oh, it's breaking out, looks great, we got all this flow, all this momentum, we got everything here, let's take it long or take it short if we're at the lows. But if you've already got the bias that today's supposed to be a sideways day, then you don't try to trade that breakout, because you know, no matter how bullish it looks, it's not supposed to break out today. It's a sideways day. We're playing the range. We're waiting for CPI. The breakout isn't true. And you wait. I'm not always a fan of waiting for entries. You know, they say waiting is confirmation, but you pay for that confirmation. It increased your risks. It's just not best practice to always wait. But if you're expecting a sideways day and price challenges the top side of that sideways day, you're better off assuming that you're right, that the range is going to hold and not trading that breakout, but also at least letting it prove to you at least once, that it is a range day. There is a difference, by the way, between a sideways day and a range day. So that adds also, but the bias is stronger than the price pattern on a sideways day. Like we do every Friday, we looked at the next week's range, but on Friday mornings when we look at it, it's not set in stone. So it is locked in place now. We can compare our new week and the range that we have with the range that we had last week. We can see that the volatility is reduced slightly. The size of the range for this week is less than the range that we had last week. That makes sense. When we have a big event, the market will start to go sideways and chop, waiting on that big event. It reduces volatility. That's why we're waiting. Make no mistake about it, though, CPI is a big one. It's not as big as like an FOMC day, but it's a big one. And after we get CPI, the market's very likely going to make a healthy move one direction or another. So just because the volatility is showing as less doesn't mean that they think CPI won't be impactful. They're just implying that we're going to go sideways half the week while we're waiting on CPI. We made some reasonably decent moves, like we were talking about with the Dow. If we start counting candles, how many days now it's been before we, by the time we've had a down day. So we have to start thinking, are we overbought? Have we moved too far, too fast? We overextended. Does it owe us a pullback to mean? If we look at the distance from the 10-day moving average, the answer is no. We're not overbought. We're not overextended. We haven't traveled too far, too fast, and it doesn't owe us a pullback. Now, I'm not saying that we can't pull back. I'm just saying it doesn't owe us a pullback. take a look at the 10-week. It's the same thing. We can see that we're not overbought. We're not overextended. We've been farther away from the 10-week most of the year. So we're kind of just getting back into our rhythm, back into our sweet spot. We're not overbought. We're not overextended. It doesn't owe us a pullback. It is worth noting where we've been for most of this year. Here's January. So the high point on the year is around 1.5. That's been the area where we pause, we consolidate, we let price and the 10 kind of reunite. This can happen two ways. We can stay sideways and chop and give that 10 time to catch up to us, or we can turn around and go back towards the 10. Well, everybody's already been talking about, and you've heard me say it multiple times today, we're expecting a sideways day, Monday, Tuesday, and part of Wednesday, or at least the overnight part of Wednesday. That would fit with the narrative that we're expecting to fade back towards that 10, or that we're going to hold the line and let that 10 come to us. So that fits. From a pure price method, we still just have this one pullback, and we don't yet have this lower high. Until we fall away from this, it's not a lower high. Now on the daily, not so clear cut as that. But I would contend that when the chart is a little messy and you're having a hard time with it, just go to a higher time frame. That really works for equities, by the way. You know, if the daily chart is a mess and you're just really struggling with it, go to the weekly. And then if that doesn't clear it up, go to the monthly. So in the S&P, especially with the ES, this has just been a really nice pullback, and it didn't give me that 7% that I was looking for. But when the pullback started, when we really started to break down below that 5,200, I started talking about pre-COVID years. Back pre-COVID, when we would get a 5 to 7% pullback, and it just kind of wash things out and get us ready for a new leg up. Well, we didn't quite get 7%, but 6.94 is pretty darn close. So far, we're just doing what we're supposed to be doing. It's right on schedule. The concern is that it'll end up doing what we did back here. We pulled back, we started working our way back up, stalled and broke that low with a new low, and then broke that low with another new low and had a more significant pullback. So far, we don't have that. The danger is 5,300. Setting a lower high is the issue. So between now and Wednesday, with all this hurry up and wait on CPI, there has been times where we're expecting CPI, and so everybody's kind of expecting a sideways week, and then we don't get it, and we break out and really move on the week. Now, there's a couple of reasons for this, but one is when the volumes are light, price can really, really move. And I know I get it. A lot of newer traders might not grasp this concept. It just kind of doesn't make sense, right? That if there's low volume, why would we move? But see, the way it works is all these numbers here, these are waiting orders, right? Waiting orders don't move the markets. Market orders move the markets. But this is in the way. So if it's a light day and we've got something that looks like the NASDAQ, something really thin. If we got single digits like this, 4, 7, 5, 12, that's really thin. One big order of, say, a 20 lot could move the NASDAQ 1 full point in the blink of an eye. Well, a 20 lot's not really a big order. We see 100 lots come in on the ES all the time, more than that. If it's a low volume day and there's just not a lot of liquidity on the dome, it doesn't take much for a big player to come in and bully the market, push it in whatever direction he wants. So on a CPI week where we're all sitting around expecting low volume and holding the range, it's possible that we get instead a big rip breakout week. And we make it all the way to the weekly expected move by end of the day tomorrow. So here was Monday and Tuesday before CPI, and then the CPI day, big move. The Monday and Tuesday, we really didn't close very far away, but we had some big moves on that day. It's more than an 80-point range, or close to an 80-point range, down and back up again. Same thing here. 2 days in a row, we really didn't do that much, but if you look at the total sweep between those two, it's a pretty good size move. It's 100 points between top and bottom before CPI. Now, granted, on this one, we really didn't do too much. So that one is one of those that actually stuck to the sideways. We had some big moves in front of this CPI. So, you know, just because most of the time we wait on CPI doesn't mean we're always going to. And when you go back and look, you'll find examples where we didn't. But until it tells us otherwise, I would prepare for a sideways day, meaning we would want to short against the high, buy against the lows, anticipate that double top reversal if you want, let it happen, let it prove that it's actually going to hold, and then trade it. There's no reason to just jump on before it's even, proven to be true. And that if we do get beyond the 1, 2, 3, 6 today, then it's a true breakout and you can play it to the other ADR level, very likely. Things that are up today: Bitcoin, China ADRs, semiconductors, tech, of course, and the Mag 7. And things that are down: nat gas, gold, gold miners, although those aren't down enough, so we'll just let that go. gold being down kind of adds to the equity bullish bias. Not seeing a real theme in the names that are up this morning. In the spaces that are up, the sectors, the ETFs that are up, sure. But collectively, if we were looking at the names that were up, nothing really stands out there. All right, commodities are down, or at least agriculture is down, and gold. So that'll help with equities. The VIX is up. I would say it's a rebalance, something, because that doesn't look up. All right, yeah. New contract, so gap. Bitcoin, which means we should have coin hut. I really don't like Hive, but Hive is another one, or Riot. MSTR, but that one's also trying to give it back. I think really most of those didn't look that good. Coin is still holding its own, but it would be the only one. The others really didn't look that hot. But we do have Bitcoin, the China ADRs. Baba's got earnings this week, by the way, so just kind of, caution on that. But the China ADRs being up means Baba, Baidu, JD, BDD, not really XPEV. I mean, it is up a little bit. Doesn't look that good. Neo, another one. I continue to like EDU. This has a long ways to go still to kind of reclaim its old levels. And it's certainly slowed down a bit. But if we get past that halfback, I think we can continue to focus on getting back up to that old level. It's interesting that we got small caps up this morning, right? The Russell was up one of the most. But we continue to see the Dow, we talked about that at the start. Dow large cap, and then FXI, it's China large cap. The Mag 7 still doing good. So we have a little bit of a rising tide scenario. Might have a nice setup in meta too. We're getting kind of close to that gap close, that 494.5, 493.5. We are IX10. This little bit of a fade down this morning. It closed at 476 and it's at 474.5. So we've faded back a little bit, like a half back on Friday's levels. We'll have to shoot it the other direction. We got to stay above 473.5. If we can do that, maybe rest on it as a demonstrated support level, then we could try to run back up, break that 477 and get this gap closed. It's still a lot of work. We're not talking about a single day. And, you know, you do have the 5-bar rule and it's way past the 5 bars. But Apple's up, Microsoft, Tesla, you just kind of go down the list. NVIDIA had a really big upgrade this morning. I can't remember the name of it, but I'll end up posting it later. So Bitcoin, China ADRs, crude, big tech like the Mag 7, silver, which I would expect to see gold start to turn around. It's odd to see this disconnect between silver and gold. That might be a bit of a tell too. Kind of watch those two and see if silver's going to fade or if gold's going to rally. Because otherwise, maybe running a pairs trade split on those two coming back together, that might be a really good play too. I don't know how many of you do pairs trading, but Tasty makes it pretty easy. Thinkorswim's got pair charts already set up for you. You just got to bring them up. SMH really isn't moving. You would think it would be doing more with the NVIDIA move. And this isn't really inspiring yet. So that's another tell. Watch to see if the other semiconductors are going to come up with NVIDIA or if NVIDIA is just going to stall out if it was a like a fake break. So we got some plays. We're not going to just, you know, be stuck waiting on CPI all week. In the indexes, we might be, but for equities, it looks like we've got some fake plays or maybe some breakout plays. And between the two, the way we were just talking about playing them off each other ought to give us the clues for which way we need to go. Everybody, be careful, be safe,